you for joining the Northern Miner here in Boca Raton, Florida. We're joining Rick Rule at the Rule Investment Symposium. Thank you very much for joining me, the man himself, Rick Rule.
A pleasure. Thank you for coming down. I've been a beneficiary of the Northern Miners' work since university in the 1970s. So
wow.
It's great to have you here.
Excellent. Always a pleasure. Right, so let's just dive right in. Yesterday on stage, you mentioned that Americans hold about 141 trillion in net worth, 30 trillion in net debt, and about 100 trillion in off-balance sheet obligations. How do you use those figures to size resource allocations today?
Well, traditionally, as an example, gold has done well during periods of time when people are concerned about the maintenance of their purchasing power in fiat-denominated, US dollar-denominated obligations. I would suggest that the fact that we're worth collectively 141 trillion and we owe 130 trillion, particularly when the debt is growing on and off balance sheet by $4 trillion a year, should cause precisely that concern. All I was trying to do with that was put into quantifiable terms what people were going to hear from the macro panel. I wanted to introduce the math. If you believe that gold does well when people are concerned about the deterioration of the purchasing power of the US dollar, what I try to do was put in context why people should be concerned. I read a little poem which I'll recite for your listeners. When your outgo exceeds your income, your upkeep becomes your downfall.
Right, that's very cute, but it's a very powerful little poem. Yeah. Okay, so you urge us to thrive, not survive, by backing businesses with pricing power. What signs do you look for when judging a resource company's pricing edge?
Well, I was trying to say there, it doesn't need all to be resources. I pointed out that in the 14-year period, 1968 to 1982, when the equity markets were sideways to down, Warren Buffett delivered a 22% compound internal rate of return outside resources. Resources aren't going to be all of anyone's whole portfolio, but you need to pay attention to a different kind of company going forward than the kind that you've paid attention to in the back. With regards to natural resource investments, I suspect that the wind, particularly in the gold sector, is going to continue to be in your sails. People have asked me, do you think that gold has run its course? I, of course, came into business in the decade of the 1970s, and I would remind your listeners that in the 1970s, the last period of sustained deterioration of the US dollar, the gold price ran 30-fold. So when people ask me, is the game over? I say, have we solved the debt problem? Have we solved the deficit problem? Have we solved the entitlement problem? Have we solved the spending program? If the reasons to own gold haven't gone away, gold doesn't go away. Later on in this decade, I think that we're going to have a more broader-based natural resource market, both because inflation will make replacement more expensive, but also because we've underinvested in natural resource front-end exploration activity for 30 years. And those chickens are going to come home to roost, exactly as they came home to roost in the decade of the 1970s. The 1970s were partly the culmination of a 30-year period of underinvestment in natural resource and extractive industry, front-end expenditures. We're facing the same thing today.
Okay, so how would you suggest investors position to take advantage of this opportunity?
Great question, but impossible to answer. If you assume that there's 8.2 billion people on Earth, there's 8.2 billion answers to the question. How hard are you willing to work? How much risk are you willing to endure? How much volatility are you able to endure? What's your time preference? I understand the question, but the truth is I've graded now tens of thousands of portfolios for people. And I've learned painfully that there's no one-size-fits-all answer.
So you mentioned the concept of doing the work, whereas an investor could perhaps just invest in the deltas like Wheaton Precious or Agnico Eagle. But what does the work entail if an investor wants to actually play the smaller stocks?
We urge people to use this conference in conjunction with the Rule Classroom, where there's a couple hundred hours of instructional programming. It's very important that you understand how to do at least rudimentary securities analysis if you're going to take some risk in your portfolio, if you're going to go after alpha. As you suggested, for many investors who just want to shield themselves from the deterioration of the purchasing power of fiat currencies, You should own the metal, and you should own the best of the best. You should own the Francos, the Wheatons, the Agnico Eagles, and then read books, garden, play with your kids, whatever you want to do. The truth is, in a gold bull market, the best of the best give you very, very, very good returns with no work and very little risk. If what you want to do, however, if you're a Northern Miner subscriber and you outperform the market, if you're looking for alpha, then you need to do the work. You need to understand the track record of the people running the company. You need to understand something about the unanswered questions that will increase the market's understanding and hence the price of the investment. That gets much, much, much more difficult. We have given people here a curated list of 65 exhibitors. It is, in order to be an exhibitor at this conference, you have to be owned in the accounts of the conference sponsors. So we vetted every single exhibitor. That doesn't mean that the share price of everybody here is going to go up, but it does mean that we've given you a shopping list that's been curated. We turn down more exhibitors than we accept. The idea is that you use the information that you get from the podium on the exhibitors, learning how to, in movie parlance, segregate between the good, the bad, and the ugly. And then, hopefully, the conference more than pays for itself based on the shopping list that we've assembled for you.
Yeah. Fair point. There's a great shopping list available here, but we find ourselves in turbulent geopolitical times, really. You coined the phrase pounce, not panic, for market meltdowns. How do you tell a genuine sale price from a value trap?
Well, every time I buy a stock, I write down on one page why I bought it, what will cause me to sell it. Money is made, from my point of view, on the disparity between the price in something and its value. If you have an opinion as to value, price begins to matter. For many people, they have no opinion as to value. They don't know if 60 cents is overpriced or underpriced. For me, when I have an opinion about value, I might be right, I might be wrong, by the way. A precipitous decline in the share price, if nothing has happened to change the underlying value of the company, represents an opportunity as opposed to a threat. If you think something is worth $2 and it's selling for $1.75, and then it falls to selling for $1, what's really happened is that good has gone on sale. That's an opportunity as opposed to a risk. Similarly, if you think the thing is worth $2 and it goes to $4 and nothing has changed, except the public's perception, while you're happy about the fact that the share price has doubled, it's become precisely twice as risky.
Right. Okay. So you warned against relying on fixed income retirement and advised younger investors to invest into knowledge and reputation. What 3 skills or connections must a junior geologist build to compound value over decades?
That's a great question. I had the huge advantage when I was a very young man of, probably accidentally, running into extraordinary mentors. And what I was able to offer as a young person was interest. These people could tell that I had a real hunger for knowledge, and the consequence of that is that I was fun to teach. I also worked very hard for them. I had the extraordinary good fortune at age 21 to fall under the spell of one Adolf Lundin. Rest in peace. The idea that one of the greatest financiers in the history of junior exploration was accessible to me was incredible. The truth is that these people are accessible to everybody. The CEO of Agnico Eagle and the CEO of Wheaton Precious are walking around the floor at this conference. Any young geologist who happens to be here would be well advised to go up, shake their hand, give them a call, and say, I would love to visit with you at some point in time. I think with regards to those 2 gentlemen, the probability that they will honor that request is 100%. You just have to ask.
Very valid advice there. So I apologize, I'm taking you on a whirlwind here. I want to touch on the mergers and acquisitions in the industry as well. How do you read the landscape at the moment in the juniors to mid-tier section? Do you see opportunity?
Oh, right now it's extremely healthy. Right now we're in the early stages of a bull market, so the stupid asset allocation, the stupid acquisitions aren't happening, which is wonderful. There are a couple reasons why well-constructed M&A works well for everybody. The first is that if you consolidate more assets under one management team, you lower general and administrative expense relative to assets under management and or free cash flow. The second thing that happens is that with the increase in passive buying, the larger companies with larger market caps enjoy more trading liquidity, hence higher share prices, hence a lower cost of capital. The combination of the more efficient allocation of capital with regards to G&A and a larger, more liquid market cap, lowering the cost of capital. Cost of capital is a definitive competitive advantage in a capital-intensive business like mining. Right now, we're truly in the sweet spot. There's lots of room for strategic consolidation. There's lots of room for intelligent consolidation around simple math and simple mass. And the market will respect this. The larger companies with lower cost of capital will either take over the smaller companies, or value arbitrageurs will look down the quality trail to anticipate that type of thing, to equalize value. We're in the sweet spot right now.
Right. Okay, so let's quickly talk a little bit about the conference itself. How many attendees registered this year? What's the main theme?
I think there's two different constituents here. One is the live conference. There's about 600 paid attendees live. More people, because all of the exhibitors, are here. They brought spouses, the speakers, stuff like that. So there's probably 800 or 850 people floating around this wonderful resort. There's another 1,300 attending from 33 countries around the world via live stream. Post-conference, we will probably sell 300 copies of the recording. So the total reach of the conference is more like 2,200 or 2,300 people directly.
And these would be retail investment, the retail investment crowd mainly?
Mostly retail investments. There are 8, as far as we know, 8 wealthy private family offices represented here. We don't know who all the live stream people are because we don't have as much familiarity with them as we do the live audience. Understand that this conference is almost 30 years old, so there's a constituency that comes year after year after year that we know well. The live stream component is only 4 years old, so we don't know those people as well.
All right, so I want to jump back to some macro themes. One of the key takeaways I took from yesterday's presentations was that it seems like with the geopolitical tension building and the debt situation deteriorating in America specifically, it looks like access to capital and debt specifically might become more daunting for junior miners or resource developers. Do you agree with that take? And where does this situation steer into eventually? How does this resolve?
I'm afraid, unfortunately, that there will be more capital available to the juniors.
Okay.
The junior industry is, I believe, hopelessly overcapitalized. I believe that probably 85% of the junior listings should go to their intrinsic value, which is 0. And that the capital then should be concentrated on the best of the best. My experience has been that a rising tide floats all ships. And my experience tells me that if the industry enjoys a couple more years of rising share prices like they've enjoyed in the last year, that generalist investors will come down to the space and they'll allocate capital stupidly.
Okay.
I understand that most of the issuers disagree with that point of view, but I've learned in my life that the industry is really hopelessly overcapitalized, and that what an investor has to do is segregate between the good, the bad, and the ugly. And that's really the theme of this conference, how you do that, how you allocate capital efficiently. The best of the best were able to raise money consistently through the bear market. I remember 3 years ago people saying, there's no money in the sector. And I'd go to participate in private placements for high quality juniors and they were consistently oversubscribed and nobody was giving me a warrant. The idea that there was no inducement to separate me from my money belied to me the suggestion that the industry was undercapitalized.
Okay, that's a very interesting point. So lastly, let me ask you, in the record gold price environment, when thinking about producers, how confident are you that they would not repeat the sins of the past by making stupid acquisitions and spending capital unwisely?
I think they will.
Yeah.
But I don't think they will for 2 or 3 years.
Because the damage is lasting, right?
When the gold market overcomes the skepticism that it still, for want of a better phrase, enjoys, and when aggressive management teams are rewarded that activity will become pervasive again. The truth is, sadly, that stupidity is ubiquitous, and it will return to the sector. But it won't return to the sector for 2 or 3 years. The institutional investors that are in the space now were in the space in the period 2000 to 2010, where the worst of the prior sins occurred. And right now, the industry is subject to the reins of experience.
Right.
Which is very healthy. As I say, right now we're in this wonderful sweet spot where the wind is at our backs and we aren't confident enough yet, we aren't hubris-ridden enough yet to make the mistakes that plagued the industry in the decade 2000 to 2010.
Very interesting. So what's the most controversial take on the industry that you're willing to share with my readers and viewers?
I guess the suspicion that it isn't actually, over time, a contrarian, countercyclical business. There will come a time when the gold trade becomes a self-fulfilling prophecy, and people won't be coming into gold to protect themselves from the deterioration of the US dollar. They'll come into gold because the price is up. It's odd, but rising price levels justify the narrative. But by the time the rising price levels have justified the narrative, they're often so high that they're valueless. There will come a time, I think, when the gold price outpaces the deterioration of the US dollar and momentum players come in place.
Those are the big guys.
Yeah, people need to understand that in every market, ultimately the cure for high prices is high prices. The cure for low prices is low prices. When the narrative around gold becomes a self-fulfilling prophecy, then investors need to have the maturity to trim their positions and look for something else that's hated. Which is tough to do.
All right, that's a good point to end on. Thank you very much. That was Rick Rule of Rule Investment Media, the host of the Rule Resource Symposium here in Boca Raton, Florida. Thanks.